The 4-step playbook for opening an offshore bank account. 1. Determine eligible countries for banking offshore. The first and arguably most critical step in offshore banking is identifying which jurisdictions are both legally accessible and strategically advantageous for the prospective account holder. Eligibility is determined by 4 primary variables. Citizenship. While most nationalities are eligible for offshore banking, U.S. citizens face greater scrutiny due to FATCA compliance. Conversely, Canadians, Europeans, and Australians typically face fewer restrictions. Residency, where one lives, earns income, and pays taxes impacts eligibility. Certain residencies may restrict offshore banking access due to local laws or international agreements. Deposit capability. Offshore accounts generally require significant capital. Minimums range from $5,000 to over $500,000, depending on the institution and jurisdiction. Purpose of the account. Banks may require proof of economic substance or legitimate business purpose for account opening, such as diversification, wealth preservation, or investment access. Footnote. This section outlines the 4 determinants: citizenship, residency, deposit size, and purpose, that govern which countries allow you to open an offshore bank account. 2. Identify compatible financial institutions. Once a jurisdiction is selected, the next step is determining which banks will accept a given client profile. Compatibility is determined by assessing 4 additional criteria. Source of income and wealth. Traditional business income is more favorably viewed than recent crypto gains. Transparency and documentation are essential. Liquid net worth. Some banks, particularly in jurisdictions like Singapore, require proof of $1 million plus in liquid assets to qualify as a high net worth individual. Maintenance balance. Banks assess not only initial deposits but also projected ongoing balances. Falling short of expectations can lead to account closure. Transaction activity. Banks assess frequency, size, and destination of transfers. Acceptable transaction patterns must align with anti-money laundering, AML, and Know Your Customer, KYC, standards. Footnote. This section addresses how banks vet potential clients based on source of funds, liquidity, ongoing balances, and transaction behavior. 3. Become a profitable client. Banks are businesses, not charities. The more profitable you are to them, the more welcome you are. Profitability is achieved through 5 major avenues. Account and service fees, basic but not particularly persuasive in gaining favor. Wealth management. Clients with substantial assets paying advisory or performance fees are highly desirable. Premium services. Banks favor clients requiring structured products, custody, and private vaulting. Asset-backed lending. Clients using Lombard loans or similar services signal significant portfolios and stable income. Foreign exchange. Regular currency exchanges offer banks consistent margins and are ideal for international clients. Footnote. This section outlines how individuals can become attractive, revenue-generating clients by aligning with the bank's preferred services. 4. Decide on deposit strategy. Opening an account requires more than interest, it requires liquidity. Offshore banks expect deposits between $25,000 and $2 million plus, depending on the institution and location. Lower tier accounts, for example, $5,000 to $25,000, are possible but may incur higher fees due to reduced profitability for the bank. Deposit size directly influences service quality, access to investment products, and long-term account viability. Clients should determine minimum opening deposit, long-term balance expectations, use of funds post-deposit, static savings, investment deployment, transactional use. Footnote. This section emphasizes the importance of deposit size and strategy in determining account acceptance, service level, and long-term sustainability.